Good evening, everybody. I'm Simm. I founded Impax Asset Management back in 1998, and I own about 7.5% of the company. I haven't really sold any shares in nearly 20 years. So what I'd like to do in the next 15, 20 minutes is give you an overview of the business. Impax Asset Management, as I'm recognizing a few faces in the audience. For those of you that don't know us, we're an investment management specialist. We are focused on investing in the environmental and sustainable development area, which we do in entirely mainstream capitalist terms, and seeking to make excess return for our clients, which are institutional and retail investors around the world. Just in terms of structure, I'd like to give you an overview of what the business does, investment rationale and our real edge and the strength of our brand, and then take you briefly through the 2017 highlights. Now, given the timing of this event, we are just a few weeks before the publication of our interim statement, and so the numbers are a little bit out of date, but I can give you a sense of where the assets under management have been heading since 1st of October 2017, which was the start of our financial year, because we do actually publish the AUM numbers at the end of every month on our website and have quarterly RNS releases as well. So the world of investment management, many of you will be familiar with it. It's changing quite rapidly. It's splitting into two, it's bifurcating. There's a big move, as everybody knows, into passive investing. The Vanguards and iShares, BlackRocks of the world are gathering enormous amounts of money because they are deemed to be providing very low-cost routes into equity or fixed income or other markets. But then there's also a second part of the investment management market which is flourishing, which is the specialist boutique investment market, where investment managers with a differentiated investment strategy are able to carve out a position as quite often global brand leaders like Impax is doing something which is different, which is very thoughtful, and where the capacity for attracting money is probably quite constrained. So that's where Impax sits. We have been in this space, the environmental, the sustainable development space, since inception. And after 20 years, I think we're recognized around the world as one of the leading brands for asset owners, for large pension funds, for sovereign wealth funds, for retail investors all over the world, looking for exposure to the themes and investment opportunities that I'll mention. So today we're managing £11 billion. If you've followed us at all, you will know that we made an acquisition the end of last year, which closed in January, which was of a company in the United States, which got a very similar name to us, called PaxWorld. It's entirely coincidental, and I'll explain the rationale for that towards the end of the slides. PaxWorld at the time of announcement was approximately 1/3 of the total business, so in other words, half our size. And the assets that they ran out of Portsmouth, New Hampshire, are shown in the blue, whereas the assets that we run out of London, the UK, are shown in the green. Those assets in total can be described in three asset classes, so equities, fixed income, and real assets, which essentially is private equity. So what do we mean by the transition to a more sustainable economy? Well, essentially, you'll know if you invest in the clean energy sector that the majority of capital going into power generation at the moment is into renewable energy. You'll know that if you invest in the transportation sector that there is a revolution underway, two areas. One, the move to clean vehicles, and second, the move to automated vehicles. It's highly uncertain the timescale of those changes. But those are just two illustrations of what we see to be global trends for new market creation around opportunities linked to more and more people on the planet consuming more and more stuff, increasingly moving to urban areas. And the response from governments, from people providing and developing technology, and from people involved in building and growing and merging companies is creating a lot of dislocation. That dislocation leads to opportunities for specialist investors that can really get under the skin of these technology, regulatory, and business M&A type changes to understand where value is. And that's in a nutshell what Impax does. So we have a team now of over 50 investment professionals, probably the largest team dedicated to this space anywhere in the world, that's working non-stop to look at these opportunities and to put together nicely risk-balanced portfolios for very sophisticated investors. This is our history. This is my life for the last 20 years, starting from a very small base. Our first client was the World Bank. We had a $25 million mandate to run a solar energy fund. And there's lots of history in here, but we've been through a couple of very severe market dislocations, of course, the end of the 90s, 2000, 2001, and then, of course, the big financial crisis. We have weathered both those storms, and we have grown our business to be a very well diversified global player from nothing. That's what the team's done. And that's illustrated in these assets under management numbers at the end of every year. So this slide really summarizes the pre-Pax acquisition investment pitch. So if you remember that donut shape, the green element is really in the environmental space as opposed to some of the other sustainable development markets that I'll come back to with Pax's expertise. So essentially in these 4 areas, clean energy, water, waste and materials, and food and agriculture, there are these trends developing on a secular basis that are leading to rapid growth, markets that are expanding more rapidly than the mainstream economy is on average, and where this dislocation is giving us an advantage in terms of asset selection. Bit of data here on the growth rates. So each of these green bars summarizes the annualized returns of 4 of our strategies. So our specialist strategies, global small cap, as an example. And you can see compared to a global equity index, I think this is the MSCI All Country World Index over the last 5 years. The earnings of the underlying companies, this is not our investment performance, this is the underlying companies, has been dramatically stronger. And we think that the fundamentals are in place for this sort of earnings outperformance to continue. How do we reach our clients? Well, we built brick by brick a distribution architecture which essentially comprises 2 things. We have our own sales force, which is based in the UK and in the US, where we're doing direct sales to clients. And then we have a majority of our business actually through third-party distributors, for example, continental Europe, Australia, Japan, and Canada, where we team up typically as sub-managers to a larger brand, for example, BNP Paribas, who will then create, badge, and sell a fund, allowing us to do the sub-management work at a relatively low marginal cost. The company in which you can invest on AIM, Impax Asset Management Group PLC, has a very simple share structure. So management owns 1/3 of the business, and as I said, I own about 7.5 of that, 33%. BNP Paribas Investment Partners bought in on the secondary market and now has 24%. So sorry, they bought in 2007, they now have 24% of the business, and the rest is what we're terming free float, which includes Fidelity has got a percentage, I think is around 6%. It's obviously declared. And then there's a number of UK small cap managers, some of whom are declared and others below the 3% threshold. So this is what we could refer to as a sort of stable triangle. So we've got a management team with a lot of skin in the game. We've got a big distribution partner who has very significant alignment of interest to carry on selling more product. And then we have a marketplace, which of course potentially could include some of you, which helps create a transparent and liquid price. And crucially for the management team, I think it allows those people who, for whatever reason, want to sell a few shares or buy a few shares to do that without any dislocation to the business. So that sort of triangle of stability we found has been really structurally rock solid for since 2001 when we went on to AIM in the first place. So business highlights for 2017. Apologies that this is a little bit ex post, or out of date. So this is the calendar year to the end of September 2017. We had at that point reported 61% organic growth in assets under management to reach £7.3 billion. We'd announced the PaxWorld transaction, and we'd announced very strong investment performance and inflows. This is the investment performance. So again, picking 3 of our strategies compared to the MSCI All Country World Index. These are 1-year returns in the light green, 3-year in grey, and 5-year in green. And again, you can just see by the sort of relative size of the columns that we've had a good record of the last 5 years and actually longer of outperforming what most investors who would hire us are asking us to beat, because they're taking money out of their global equity portfolios and giving themselves a tilt towards the environmental space, and they're asking us to stock select in that area, if you like. Our private equity infrastructure business, so this is our real assets. Remember I said we got equities, fixed income, which is PaxWorld, and real assets. So this is the real assets business. Since 2005, we've been running a series of limited partnerships investing in the renewable energy sector, predominantly in Europe, to fund the development and construction of onshore wind farms and solar projects. This is a very fragmented industry. Lots of farmers leasing land to small-scale developers tend to be undercapitalized. We're doing a very thorough sifting process to find out the developers with the best projects, the best free cash flow generation opportunities, and then we are putting in the equity and raising the debt to fund the construction of those assets and typically paying the developers a nice fee to go away, leaving us with 100%. And then we're selling into a very burgeoning, very buoyant demand for built assets, which is coming, of course, from utilities who want the power generation, but it's increasingly coming from financial investors like yieldcos, which are listed renewable energy investment companies, and or institutions like German insurance companies. So we're making sort of early teens returns, which for limited partners like pension funds is very nice given the level of risk. The client breakdown is shown in this slide. So grey bars at the end of September 17 versus green bars a year earlier. So you can see in the 12 months we've had a very strong push or growth in EMEA, predominantly continental Europe, and a nice percentage growth in North America as well. This is also pre-Pax. Financial highlights, there's a table here which is showing the results. I'll just go through the highlights in the next few slides, so you don't need to pay attention to that. So revenue had grown quite considerably. Grey bar, or dark green grey, is the latest compared to a year earlier. And we've turned that into some very nice operating earnings. Operating margin was on the run rate basis just over 30%, which in investment management terms is sort of in the right ballpark. That was at the end of the year. And you'll notice the difference between the 9.3 number and the one in the table I've just shown you, and that's a reflection of some national insurance accounting, which we've stripped down in this number to give a truer version. Earnings per share had gone up very considerably. Our balance sheet had remained pretty stable because we've been able to raise the level of dividend, and the level of investments had fallen as well as cash grew. We started paying a dividend in 2008, and since then we've had a progressive policy on dividend. We initiated an interim dividend in 2014, and you can see here a nice trajectory. Pre the acquisition of Pax, we've been thinking that we might actually move to more of a payout ratio, but we've now taken on some debt, which partly funded the acquisition, and I think until that debt's partly or significantly paid down, we won't be changing that dividend policy, but still confident to be able to raise the dividend progressively over coming years. And this chart, so I won't dwell on the numbers, but this essentially is making the point that there's huge operating leverage in this business. So when you get to scale, you get to critical mass, then you can really rapidly ramp up operating margin, because the marginal cost of running these funds is relatively low once you've got to scale with your team. So just finally then, a few words about the acquisition that we made. We weren't actually looking to make acquisitions. This is not a business that's predicated on bolting on lots of teams onto a common platform like some of our peers in the AIM market. We have a very singular and distinctive investment philosophy. We have a dedicated team with an incredibly low staff turnover, and we're not looking to grow that per se through acquisitions. However, since 2008, we've been working as a sub-manager for this group in New Hampshire, in the United States, to sub-advise, legally sub-manage a retail or mutual fund for American investors. Now, given the regulations around that, we decided in 2008 that we didn't want to put our heads above the parapet and manage one of those, but if we could find somebody to sub-manage for, that would make it a much smoother ride. So we've had a 10-year relationship with this group, PaxWorld. They are a investment manager dedicated to US clients, almost dedicated to retail US clients. Very similar investment philosophy to ourselves. So for 10 years, we've been building relationships with the CEO all the way down. And when it turned out in early 2017 that the company was effectively for sale because their family owner wanted to liquidate because of change of circumstances, then we were able to move in on a uncompeted basis and strike a deal, which essentially means that we bought the family stake and a little bit of extra shares. So we now own 83% of this business. The remainder is owned by management. There's an earn-out in 2021, and we're in the process of integrating the business, as I'll explain in a moment. So that's a summary of the transaction. We closed in January. We've renamed their business Impax Asset Management LLC as opposed to Impax Asset Management Limited, which is the London company. As you'll see from the structure chart, that's, if you like, a sister company now under the Shell PLC, which is the parent company. But Joe Keefe, the president of PaxWorld or Impax Asset Management LLC, reports to me, but his team are essentially unchanged. So that allowed us to have a big step up from the £8 or so billion at the end of September to the £11 billion under management today. So what is it that's complementary about this business? Why did, from a sort of corporate finance perspective, why was it interesting? Well, I think for a number of reasons. Number one, it crucially gives us additional capacity and capabilities. So fixed income, there's some passive or smart beta strategies that they run. And therefore, you can see from the ticks on the right-hand side that there's fairly limited overlap in terms of products. So putting on, if you like, one platform, some new capabilities gives us a visibility, being able to expand this business dramatically compared to where we were pre the acquisition. Second reason is that it gives us more scale and more visibility in the United States and diversifies our dependence on some distribution partners, particularly BNP Paribas. And so today, post the acquisition, we are approximately 50% of the team is in the US and about 50% of our clients in the US as well, with the rest being predominantly in Europe. This couple of tables shows the sort of pre-acquisition and combined group afterwards. So you can see a big leap in revenue and crucially EBITDA, but shares and issue went up from 127.7 to only 130.3. Now, I think obviously the benefits to shareholders from that in terms of EPS enhancement are enormous, and those are going to come through in the numbers over the next 2 reporting periods. We were able to do that because we had quite a lot of excess cash on our balance sheet, and we had no debt. And so by putting in a relatively modest level of debt, about 1.3 times run rate EBITDA, which we borrowed from Royal Bank of Scotland in 2 tranches, and using excess cash while still leaving ourselves with a respectable cash buffer, we were able to reduce the dilution to simply a 15% portion of the consideration to the family went in new equity. So I think from a corporate finance perspective, that was a very fortuitous and accretive transaction. And so this is the structure that we're left with. So this is our historical business, which essentially is that green bit in the donut that I was showing you, and then the blue bit is managed by our new friends or new sisters and brothers in Portsmouth, New Hampshire. So just wrapping up, I think if you take a step back and say, where is investment management heading in the next 5 to 10 years, and where do you want to be placing your chips if you have an opportunity to buy into a manager, then I think it's a quite interesting debate, which we don't have time to have now, as to whether there's going to be a sort of busted flush in passive equity, where there's just so much money in that space that's going to lead to market dislocation, and maybe there could be a sort of a reduction in the success of that space. Let's park that for a moment, but I think it's fairly incontrovertible that specialist investment managers with a differentiated idea and a global reach are going to be able to thrive, provided they can retain their talent and run structured and institutional quality investment processes. And so that's basically where we are. We've chosen a space which now is incredibly popular for a whole lot of reasons that you will know very well. It does speak very nicely to ethical investors, for investors who want to do something to save the world, but it's also speaking to those investors who are neutral on those topics, but are really looking for areas of the economy which are set to outperform over the next decade or so. And so we can, by careful sort of communication, we can appeal to both camps and attract money for both. The acquisition, I think, allows us, as I mentioned, to take a big leap forward. It gives us a really strong foothold in the US, which, if you know this industry, you'll be aware is the deepest, probably the most diverse market in asset management globally. And they also have a readiness or willingness to pay good fees for performance. In contrast to some countries around the world that I won't mention, where the willingness to pay is really not very high, irrespective of performance. So I think in summary, we feel that we have had a phenomenally successful 18-month period. The company is very well positioned for future growth. Markets, of course, are a little bit fragile at the moment, and so we are prepared to batten down the hatches, but now with fixed income, with real assets, we're not completely dependent on the direction of equity markets. And finally, Impax is run by an incredibly loyal band of executives and staff. We have approximately 5% turnover staff a year, and as 33% owners of the business, then we're fully aligned with shareholders. So let me stop there. I'm happy to take further questions.
My understanding is that asset managers tend to be highly cyclical, and yet you managed during the credit crunch to increase your assets under management. So my question is, first, how did you manage that? And secondly, how will you manage when the next bear market comes along?
Well, I think at the root of our pitch is that we are suggesting to clients that this is a set of opportunities which are going to play out over the next 5 to 10 years. And because we've historically and continue to pitch predominantly to institutional investors, then they're generally speaking taking that type of time frame into consideration. So we therefore have, in the two big crashes, we've had quite a limited amount of retail money, and therefore outflows have been quite limited. So in the 6 months between 1st of October 2008 and 31st of March 2009, we only lost 4% of our assets in terms of outflows. So that's point number one. Point number two is we've now got a diversified business with fixed income and real assets, so performance is going to be differentiated. And point number three is that even in listed equities, we've got some of our strategies have got 12 different clients, and the chance of all those sort of killing over at the same time is pretty low.
How big an issue is fee pressure for you guys? It's an issue for a lot of asset managers.
Yeah, so that's a good question. So broadly speaking, our philosophy on fees is that we try to charge a sort of a fair fee for a fair job. So we don't have performance fees unless our clients really ask for it. We find the complexity of negotiating those with institutional investors is just challenging, to say the least. We think there's a lot of value for shareholders, including management, if we get higher asset management or annual management fees as a result. The blended fee rate across the firm has been coming down slightly. I think it came down from sort of 56, 53 basis points approximately over the previous 12 months, but that's entirely reflective of the changing blend of the business. So more money coming in for lower fees through sub-management rather than, say, private equity business. We see very little pressure from existing clients to knock down fees, with one exception, which is for the institutions that have been our clients for sort of 5+ years. They quite often ask for sort of loyalty bonus, and we're always happy to knock a bit off to make sure that they don't run away. In terms of challenge from competitors, I would say that there's more competition coming into this space. But broadly speaking, it depends on which country you're in. We're able to sustain our fair fee for a sort of fair job approach because people recognise the quality of our work, the consultant endorsement and recommendations, and the fact that there's not that many alternatives with exactly the same pedigree. So we're not complacent, but it's not an issue at the moment.
Can you say just a bit more about competitors directly in your space and how they do compared to how you do?
Yeah. So there's really two types of competition. There's the boutiques in the space that do something quite similar to us, where probably the leaders are Sustainable Asset Management, which is a division of Robeco, which is a division of Oryx. So Robeco Sam, as it's called. There's a group called Mirova, which is a subsidiary of the French group Natixis. And there's a group called Generation Investment Management, which is employee-owned, based in London, and was set up by Al Gore and someone from Goldman Sachs Asset Management. So that's, broadly speaking, the peer group in the specialist boutiques. Our returns are competitive with those groups. The other type of competitor is obviously the big bulge bracket names, which is almost everybody who thinks that they want to be in the sustainable development space, or ESG, or SRI, or you name it. There's a sort of alphabet soup out there. The quality of those groups does vary. Some of them are excellent and others absolutely terrible. I think what gives us a real advantage is the fact that we've got an entire business dedicated to the space, and therefore clients see that we will throw everything we have at making this work, and if it goes out of favour, we're not going to run away like a bigger group might. And secondly, we just have the breadth and depth of the team and expertise and the team stability that no one else has, be they Goldman Sachs or Wellington or Bailey Gifford.
Just a quick question. The Pax acquisition came about because you had a long-standing relationship with them. Are there any other peers that you have similar relationships with, or was that a one-off?
So I think that to answer the question that you didn't ask, we have no intention of making any more material acquisitions anytime soon. We've got our hands full integrating this. We think there's a huge amount of value for everybody by perfecting what they do and scaling it up, and we're not looking for new asset classes. However, to come back to the question you did ask, we do have an enormous large array of very deep relationships, particularly with the managers or the funds that we sub-manage. So ASN Bank in the Netherlands, we've had a 17-year relationship with. They've got a fund which is now 700 million euros. We've built it up with them since scratch. We've got similar relationships in Canada, in Denmark. And that's one of the real strengths of the business, I think, is just that sort of global network of relationships, which gives us sort of... Exactly, yes. We're not... I know that perhaps wasn't the intention of the question, but relationships are right at the heart of the business, but we're not sort of sitting on other PaxWorld type relationships that might lead to acquisitions.
Thanks. Just wondering, what is a sustainable company or environmentally focused company?
Yeah, thank you. So we try to avoid the potentially ambiguous adjectives. So sustainable company could be interpreted in many different ways. So what we try to do is tell our clients that we're looking at almost industries of the future. So we're trying to take a informed view of where the infrastructure space is going, where power generation is going, where water supply is heading, which companies in the value chain or which parts of the value chain are structurally at an advantage, so low capital employed, good opportunity to defend margins, and an opportunity to scale an offering around the world to get leverage. So that's hopefully an illustration of how we think about this world and the transition opportunities in an entirely mainstream, rational way without getting caught up in what could be deemed to be sort of ethical or moral views about what's sustainable or not.
Ian, I was intrigued by the map on slide 15 for the private equity investments in Europe. You seem to have a dislike to the UK, Spain and Portugal, but you rather like France, Ireland and Germany by the looks of it, and Italy. Is that a reflection on government subsidies on these things or some other factor?
Yeah, it's a great question. So the mandate for this fund is to invest in the European Union. Therefore, technically we could go anywhere. Because we're focusing on a relatively short ownership period to buy the assets during construction, during development, and then fund them through construction, sell them once they're commissioned. What we're essentially doing is trying to build assets that people are going to pay a lot of money for. And we've worked out, I think correctly, that the countries where the assets are most valuable are those with stable power prices for renewable energy. And if you know anything about renewable energy, you'll know that there's sort of two types of power structure. One is feed-in tariffs, where you get a specified price for a long period of time, and the other is green certificates, where you get a market instrument which has its own market value, which is not stable. So the UK, in simple terms, is a green certificate market. Germany, France are feed-in tariff markets. And so that's the primary reason why we've gone for Germany and France in particular rather than the UK. The UK also is sterling country, whereas the fund's Eurozone. The UK's got a bit of a track record of should we say, nudging or changing policy in this area on a fairly frequent basis, in contrast to some of the countries that we've invested in. So that's why we've gone there.
Thank you. Ian, thank you very much indeed.
Okay, thank you.
Very interesting.